Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the grown-up money stuff and sometimes uncover a few secrets along the way, like are they really investing in real estate or just playing with paper money? Today we're diving into Invesco Real Estate Income Trust, Inc.'s latest report. It's all about their financial snapshot as of July 31st, 2025, and what that means for investors. If you like getting simple explanations of complex financial documents, make sure you're subscribed and join our Discord community, linked in the description below. So first off, what is Invesco Real Estate Income Trust, or REIT, you might ask? Think of them as a company that owns, manages, or finances income-producing real estate. They're basically in the business of collecting rent and making money from properties. This filing is an update on their net asset value, or NAV, and their overall business activities. AAV is a fancy term for what a company is worth if you were to sell off all its assets and pay off all its debts. It's like the ultimate breakup value. Now let's get to the juicy part, the numbers. This table shows us what makes up the company's total worth. They have investments in real estate worth a whopping $787 million. That's a lot of bricks and mortar. They also have investments in other companies and real estate related stuff totaling over $200 million. This means they don't own these entirely, but they've got stakes in them. Cash is always good, and they have over $94 million in cash and equivalents. But they also have a lot of debt, more than $286 million, which is something to keep an eye on. After accounting for everything, their net asset value, or total worth, comes out to over $621 million. This is the sea of money they're working with. They have about 22.9 million shares or units that represent ownership in the company. All of this value is spread across these shares. Here's where it gets interesting. They break down the value per share for different classes of shares. You can see Class T shares are worth about $26.02, Class S shares a bit more at $26.09, and so on. The bulk of their value is tied up in Class N shares, which are worth about $27.44. Looking back at the previous month, June 30th, their NAV per share was pretty similar. This tells us their value didn't wildly swing in a single month, which is usually a good sign for stability. Now they're upfront about something important. They don't discount their NAV for how hard it might be to sell their shares or the costs involved in selling their properties. This is common in real estate, but it means the actual cash you'd get if you tried to sell everything might be less than this NAV number suggests. They're basically saying this NAV is an estimate, not a promise. It's not a guarantee you can sell your shares at that exact price, or that the company would get that price if it were sold. It's a calculated value, not a guaranteed market price. Let's look at how they value their properties. They use something called a discounted cash flow method, which is basically estimating future rent and then figuring out what that future money is worth today. This involves using things like discount rates and exit capitalization rates. Scroll healthcare discount rate credited for healthcare properties. For example, their discount rate is 7.3% and their exit cap rate is 5.8%. A discount rate is like the minimum return they expect to make on their investment. A higher discount rate means they expect more return. The exit cap rate is what they think the property will be worth when they eventually sell it based on its future income. Scroll discount rate, weighted average 0.25% decrease rate per week. Now here's a sensitivity analysis. If the discount rate goes down by just 0.25%, for example, in their healthcare properties, that could increase their investment value by 1.9%. This shows how small changes in these assumptions can have a pretty big impact on their overall worth. Scroll discount rate, weighted average 0.25%. Increase rates conversely, if the discount rate goes up by 0.1025%, their investment value could decrease by about 1.9%. It's a balancing act, and these rates are determined by independent experts, which adds some credibility. Scroll exit capitalization rate, weighted average 0.25%. Decrease cyclically plays 0.25%. Their property values could increase by about 2.8% for healthcare properties. This means they expect to sell it for more relative to its rent. Scroll exit capitalization rate, weighted average of a 0.25% increase creep add. If that exit cap rate goes up by 0.25%, their property values might drop by roughly 2.6%. These numbers highlight the critical role of these assumptions in valuing their real estate assets. Scroll as of July 31, 25, our leverage ratio was 19 point crepe. Now for an update on their actual business. As of July 31st, they own 59 properties spread across the US, covering about 8.8 million square feet. These properties are mostly leased up at 91.7%. Importantly, their leverage ratio, which is their debt compared to their assets, is 19%. This is a relatively healthy level, meaning they aren't overly burdened by debt. Scroll on August 14, 2025, we acquired a fully leased industrial warehouse in Mebane, North Carolina for $39.2 million Caroline. Then a recent move on August 14th, they bought an industrial warehouse in Mebane, North Carolina for $39.2 million. This property is already leased out for about 9 years with regular rent increases built in. It's located in a key logistics area, so it looks like they're focusing on solid income producing assets. Scroll quarter date through July 31, 2025, we raised gross proceeds of approximately $18.6 million so far this quarter. This includes money from investors reinvesting their dividends and from their private placement program. Scroll the aggregate dollar amount of common stock and OP unit repurchases requested during July, which were all fulfilled effective July 31, 2025, was $0.7 million worth of their own shares in July. This can be a good sign when a company buys back its own stock believing it's undervalued. Scroll forward-looking statements, basically case to. Now they include a section on forward-looking statements. Basically, anything in this report that talks about the future, like what they expect to happen or their plans, is considered a forward-looking statement. They're legally required to tell you that these are just predictions and things could change due to many unknown risks and uncertainties. Scroll, except as required by law, we are not obligated to and do not intend to update or revise any forward-looking statement scrapesive. And they clearly state they aren't automatically going to update these predictions if things change. So it's important to remember that the future they're describing might not pan out exactly as they hope. So what's the big picture here? Invesco Real Estate Income Trust Inc. seems to be operating with a solid foundation. Their ME is substantial and their leverage is manageable. They're actively acquiring properties that are already generating income, which is a smart strategy for stability. The valuation assumptions they use are key to understanding their worth, and the sensitivity analysis shows how critical these assumptions are. They're being transparent about the difference between their calculated NAV and what might be a real-world selling price, which is important for investors to note. The company is growing by acquiring assets and raising capital consistently, referee to understanding their worth, and the sensitivity analysis shows how critical these assumptions are. They're being transparent about the difference between their calculated NAV and what might be a real-world selling price, which is important for investors to note. The company is growing by acquiring assets and raising capital consistently. Looking at their direction, they seem focused on steady growth and income generation through well-leased properties in strategic locations. A key strength is their clear explanation of the factors that influence their net asset value. A potential risk, as with any real estate investment, is market fluctuations and changes in interest rates, which can impact property values and borrowing costs. However, their diversification across property types and geographic locations, as indicated by the list of property types, usually helps mitigate some of these risks. In concluding, their NAV is a solid number, but remember, it's not a direct indicator of immediate liquidity. Their recent acquisition is a positive sign of strategic expansion. Overall, they project an image of a stable and growing real estate investment trust. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.